Hi, I'm Hunter Hutt, Director of Business Development, and today I'm here with CEO and founding partner Andrew Torres. Today we're here to discuss the recent performance and opportunity set in our investment grade credit mandates. May marked another decent month of performance for many asset classes, indicating that the saying, sell in May and go away, was, as we highlighted, not applicable. As such, our mandates were able to produce their 14th month of positive performance with our customary low volatility. Andrew, can you highlight the main contributors to performance throughout May?
Yeah, thanks, Hunter. May was a decent month, perhaps a bit of a slower month. We saw a fair amount of volatility in equity markets early on, with equities down as much as 3%. But they came back, and credit was very resilient throughout. One of the key themes that worked for us in May was the outperformance of Canada. We talked earlier in the year about how we think Canada can outperform as the reopening and vaccination story takes hold up here, and that seems to be playing out in the second quarter.
Thanks, Andrew. How are we setting up the portfolio to take us through the summer?
Well, the key thing here is to maintain a moderate level of risk. We've seen a pretty significant rally in credit spreads since last year. So we want to dial back the risk a little bit, maintain good yield in the portfolio, actively trade to generate those incremental total returns, but leave ourselves with plenty of dry powder. So if there is some type of volatility event later in the year, we can step in and take advantage and generate excess returns for our investors.
And Andrew, inflation has been on the forefront of everyone's mind. What are your thoughts, and will this impact our credit mandates?
Well, I do think inflation is the story for 2021 and probably beyond. We've seen a significant change in the central banks as they've moved towards this average inflation targeting, particularly from the US Fed. And that means that they're willing to let inflation run above the traditional 2% cap. That could mean 3%, 4%, 5%, and we don't know how long they'll let that run for. So you have to, as a fixed income investor, you have to recalibrate your expectations for returns and your demand for yield returns to adjust for the potential for higher inflation. So I think you can continue to see interest rate volatility. We've already seen a sharp backup in Q1. That could continue through the rest of the year. The other impact is how we position ourselves in terms of sectors. We've seen a strong commodity rally in 2021. The commodity sectors such as metals and oil and gas have performed particularly well for us, and we've continued to position for those particular sectors. We also see steeper yield curves impacting the banks in a positive way. So we want to be overweight the banking sector. So by picking our sectors right, by maintaining our hedged interest rate sensitivity, we think we can ride our way through this interest rate volatility and inflation story that could last, as I said, for 2 or 3 years. The important thing, though, is this is not a bear strategy on interest rates. We are interest rate agnostic, and we're meant to diversify your fixed income portfolio away from rate sensitive strategies. That's a key thing to remember about utilizing our fund.
Thanks again, Andrew. If you have any questions, please feel free to reach out to a member of the team. Thank you, and stay safe.